Welcome to the Stock Market Morning Prep video for Monday, March the 3rd. Brand new month, so it'll be really exciting to see what happens. Like I mentioned before in the beginning of the year, there's plenty of opportunity and lots of volatility that are starting to happen. So we just need to pick our spots here. Crazy price action on Friday. Quick rundown of the numbers. Dow Jones up 49, NASDAQ down 10, almost 11 points. S&P up 5, and the Russell 2000 down 4, almost 5 points. The crazy price action, it's really a perfect way to label it. At the opening, the markets ripped to new highs, made new intraday highs, and then at the end of the day, we had some geopolitical tensions starting to rise in the Russia-Ukraine situation, and the market sold off literally within 15-20 minutes to be almost, actually at one point, the indices were all red and then bounced for a quick short covering rally. But that's crazy price action. So, I mean, if you're new, if you're a beginner, you should be honestly standing off to the side, maybe one or two small little trades. And again, picking quality trades is really the way to go at the moment. Personally, reducing risk. Patience is needed in this market. There's no doubt. I've been saying it. And also, cash is definitely a position. If something is not working, something's not right, step aside. I mean, that's what I've been stating all week. This past week, markets were driven by fear and greed. We had mutual fund inflows come in, and that was partly due, I believe, usually come in Thursday, Friday, and then even follow through for maybe Monday, a little bit Tuesday, at the end of the month. You also have end of the month window dressing. So a lot of that stuff is, you have to understand how these cycles work. And sure enough, we had some crazy price action. And that to me is when I say, okay, I'm taking a step back here. I need to see all of the ducks line up in a row. And if things are giving us some major red flags, number one, Japanese yen higher. Number two, bonds higher. Number three, gold's higher. And then number four, S&P higher. I'm a little nervous about that. Remember, the bond markets, they're the smartest guys in the room, okay? They're much smarter than equities. Whatever the bond market's telling you, that's the reaction that you need to follow. It doesn't happen all the time, but most of the time. And indeed, right now we had political tensions escalate here in the over the weekend, and now we are down literally 18 handles in the E-mini S&P. So if you're long the market, if you're long a lot of stocks, you're not feeling too good this morning. But if you were nimble, you only had a couple of long plays, maybe you hedged your book, that's the way to manage money. That's the way to trade. Take a step back and look and say, hey, I'm not looking to carry any risk over the weekend. And that's what really should be doing. You should be looking at the markets as a whole, not with blinders in just our markets. Remember, we have a worldwide market here. So now I'm going to go into a couple of small little indicators and also what to follow. And by the way, the emerging markets last night really got hammered across the board. And I'm just going to show you that chart again. That's another big red flag from me. Remember, several weeks back, the emerging markets really triggered that sell-off. And then we followed suit as well. Now, when you have the markets here coming in to resistance and really bouncing, just looks exactly as what it is, a retracement rally. Nothing fearful or forceful as far as can't wait to buy the emerging market, the ETF. Markets really flagged and now looking to roll over again. That is a big signal. This is a big sign. Now we're actually even more so because we have bonds following to the upside. Gold not breaking down, okay? If anything, gold actually had a good retracement rally, but gold not breaking down. And the yen. The yen has actually now started its uptrend again. So let's take a look at all of that. But I want to show you the new highs and lows. I'm going to just watch this. This is not, this is nothing actionable. It just gives you one of your put this in your trading toolbox and just watch at the end of the day. Are we starting to spike up above these big levels? If you start getting above 200 and you start spiking, you're going to have this little blip lower. Now, remember, and I said this to you before, the longer-term picture is absolutely bullish, right? We have to continue to say that. So even if we pull back, I think we didn't get to 1781 and still be bullish. So we're going to show that to you in the charts in a moment. Here's the VIX. VIX didn't go anywhere. So at the moment, if the markets continue to hold here, now it is early, but the markets continue to hold here, VIX will start to again pop up again. Now we get back above this 200-day. You got the 200. You have the 20-day. You have the 50 underneath it. So if that gets it back above, it's going to get some good support. And then I would look for at least a test up in here. And if that happens, obviously you're going to have some pressure in the marketplace. Stocks above the 50-day moving average rallied all the way back up here into a zone area of resistance where a logical spot is a rollover. Another sign for me that this is now remember, The 8 still has to cross over for to get that signal. But remember, when you start looking at these lofty levels, what you do is say, how do I use this market? How do I make money from these indicators? It's really simple. When all of the indicators are at overbought extreme levels, that doesn't mean to take a short side. That means to tighten your stops, trail your stops up, and don't be long too much in overnight. So what you want to do is you want to make sure that you're saying to yourself, well, look, you know what? Markets could actually absolutely go higher. Maybe I should hedge my long book, or maybe I should just maybe reduce my share size here. I see some volatility coming in. And that's what you're supposed to be doing with the indicators. And then obviously the indicators will also try to help you be on the same side of what the market is doing, okay? Now, let's take a look at the emerging markets. And as you can see here, all this is a flag. We have the 5,200-day death cross here. Early February last month, and sure enough, we rallied, and now we're rolling back over. Look at the averages; they're starting to roll over. Obviously, the 8 and 20, they're a faster moving average, but the 50 pointing much lower, and look what's happening now. We're curling over to 200. Not a good sign. And then again, we are overbought on this retracement rally. I'd be looking for lower prices in the EEM. China ETF FXI, major resistance up above. We have a horizontal trendline resistance that coincides nicely with the 200-day moving average. Have the death cross here, 5,200 on a daily. Again, overbought. Well, not quite overbought here. We actually alleviated some of that overbought pressure when we actually moved lower. However, this should start to move lower again. You take out this area here, your next logical low would be this pivotal low of 33.50. Again, not looking too good. That tells me another sign. Now here is a very good sign. The dollar is breaking down severely. This is not a very good sign at all to the markets. Now, what does hold well is it puts a buoyancy on commodities, right? Precious metals, grains, crude. So you would see and you expect them to rise as dollar moves lower, okay? And U.S. equities, okay? This is an inversely correlated relationship with grains and the U.S. markets. All right, now let's go into the charts here. This is it right here, 30-year Treasury bond future, the ZB. If you take a look at this, this has a nice bull flag, lower volume, right? You could even just draw it. You could see lower volume, and now we have a high volume breakout, which is right here. The next day we broke out again, and this is this morning. We're up 28 ticks in the bond future. Now we're sitting right underneath that 200-day. If that breaks above the 200-day, you're going to test the highs. And if this market continues to rally in bonds, you're going to have continued pressure in equities, and especially you need a catalyst. And if this Russia-Ukraine is a catalyst, money will be flowing out of equities into the yen, into the bonds, into the safe haven sectors such as utilities, healthcare. Those are the two, and consumer staples as well. Those are the three, that will benefit very well for a turbulent market, okay? And that is me. This is exactly why I'm saying I'm very cautious, and I was very, very light last week, only because I'm not looking to get caught into this move up, move lower. I want to be nimble. I want to be waiting for setups, and then you can pounce with extreme confidence that you don't have to worry about, oh, I'm long and I'm wishing for the market to be long. When you start wishing, you're absolutely on the wrong side of the trade. Get rid of your trade and start all over again. Okay, but this is a big key factor for me. Now, remember, guys, the markets are down today in the early morning session. Again, one day doesn't make a trend, but the big clue was Friday afternoon when we sold off hard on the geopolitical front, and then they rallied again to close up. But that was your cue as a trader to say, I need to start looking for some short trades here. Okay, now let's take a look at the yen. Yen now has taken out of this little Fibonacci cluster. All right, now we're starting to rally. And what happens? We literally based pretty much all of February, right, up, down, and now we're starting to break back out again. Now, it has cleared an important hurdle here. Once this starts to break out, your new obstacle will be, which would be the 50% retracement, and this area here of 99.92 in the yen, right? Now, you can look at this as the dollar yen as well, right? This is inversely correlated to the U.S. markets, but dollar yen is correlated to S&P. So if you see the yen higher, dollar yen will obviously move much lower, okay? But this is another clue. This is the big one. The yen and bonds. This is major. So when you see that, you got to be careful. Here's the daily chart. Again, look at this upper right-hand corner, down 1950. Okay, now we popped up. We made all new time highs again. Everybody got all crazy, and all of a sudden, boom, markets roll over again. It caught all these retail longs up at these areas. Now remember, the markets are made to fool the masses. Keep that in mind. Every time when you think should I be buying this market up here? Absolutely not. I would never in a million years, as much as I want to, let the train leave out of the station without me. I would never, never in a million years do this. Okay, intraday day trades? Absolutely. Absolutely. Maybe an overnight swing? Sure. But to me, when all red flags are pointing lower, there's no way. That's why I take a step back and I'm just waiting like a sniper in the woods, and I'm waiting to react. Okay, now that is to me telling me that I'm using caution here. I'm watching. Now, let me just show you something here. Here's the weekly chart, right? Let me just bring this down, and I just want to show you, open this up a little bit, how if we wanted to, we could trade all the way down to this pivotal area here of 1731 and still be bullish. Yeah, that would be some. That would be obviously some a lot of worried people. But you would see, I'm just going to draw this trend line here, and this would coincide nicely with this little top end here. So even if we trade down to this area at 1739, 1740, we would still be bullish and still be in an uptrend. Now, the uptrend would be in jeopardy, but we would still be in an uptrend, okay? So just keep that in mind, guys. So it is very healthy to have the markets pull back. A well-needed pullback is welcome here, okay? Now, let's take a look at the hourly chart. And again, I did that Fibonacci from this pivotal low up to this high, and we have a 1272 extension, and that's where we actually hit. And if you remember, and I did this before the markets rally, and if you looked at it, here's the 1272 extension, 1866. Where did we hit? 1866. Believe me, Fibonacci retracements do not lie. Okay, this is from here, from this high to this low. 100% look for an extension, 1866. Hit it right to the penny. And probably even a couple of pennies above that. So now we hit and we failed. Where do we go? Now, let's take a look. Right? And I like looking at the shorter term time frames. I like go from the daily back down to like an hourly, 30-minute, even a 15-minute for that matter. This is my area here. I've had all of last year, and they don't change. They stay the same. Here's that area, 1838, 1838-ish. We're there right now, if you can see here. If we break this area, I would look for at least a small little area here, 1832, which is not going to be much at all, 1829. But really, you'll see a little bounce maybe at these little pivotal areas, these little lows. But really, the big area would be right back here again at 1817, 1820. This area here, remember now, where this 200 caught it and held, it is now going to absolutely hurt, because now we are at resistance here. This is going to act as resistance as 200. When a 200 came in and held, and we bounced hard, now this is acting as resistance along with this horizontal resistance of 1838. So now the markets have a lot of work to do. Where this was a friend, now it's an enemy. Okay, so now we break lower. I think your next major support area for the E-mini S&P would be right here, 1820, 1817. And that's going to be the first target off this sell-off, okay? And then want to show you this, and I've been showing this to you for a while now. This is Friday's price action. At the end of today, if the markets stay the way they are, this is going to be a bond breakout. Okay, now this is the TLT, the ETF, and which you can look at if you don't have the data feed for bonds. But this is a breakout here. This is absolutely a breakout. And if this continues today and it holds, this will be a confirmed breakout from Friday. Look at gold. Okay. Why is this happening if the markets were actually made new highs on Friday? This is absolutely a big red flag, guys. And I've been showing this chart for you for the last month just to show you. And that is why, me personally, and I keep saying, be nimble. The risk happens really fast. It will catch you off guard. And then you're going to say, oh, well, I'm not going to be able to cover it here. Let me wait a little bit. And then it just continues to go lower. Okay, remember we had a very accommodating market by the Fed. Let's see, November, December of 2012 and all of 2013. Things are starting to change. You can see this here, okay? Don't get caught off guard. Don't be stubborn in this market. All right, now let's go run into the indices. They were all basically up, like I said. We made new highs here, but we came back in to hold this upper end of this long-term uptrend line. So, again, markets are what? Overbought. And when you get a catalyst to the downside, people will start taking profits. And remember, part of the reason Friday was these mutual fund inflows that come in, and you have end of month window dressing. So once that's gone, it's really not much to hold the markets. When you have earnings now is gone, pretty much over, and you have to be careful here because people would really start looking to take profits. Take a look at the transports. Transport's still doing nothing here. This to me is another warning sign when you have the leader not leading. Okay, IWM spinning top here off the high, made new all-time highs as well, and again overbought. And I don't see much conviction here. So remember, guys, if you look at the down movements, the down moves, they take out pretty much all of the hard work for the month grinding higher in these large engulfing red candles. So you got to really use caution here. Okay, Qs, big long-legged doji at the upper end of the range here. To me, this is extended, overbought. Now remember, we can go higher. It doesn't mean that we can't. When they base at the upper end of the range, we can, but we've gone up so hard, so fast, you have to say, wait a minute, let me take a step back here. Why would I be accumulating stocks at these levels? Absolutely not. All right, diamonds. Diamonds not doing much of anything. Yeah, it absolutely did grind higher. Overbought state, low volume. Again, not telling me much of anything. So our markets here really didn't do too much on Friday when we actually rallied. That's, again, a big red sign. I keep stating it, but a big red signal, red flag, however you want to call it. You have to be careful here, guys. GLD, above the 200, consolidating above 200, doing nothing. Now, again, we had some great calls in the GLD. I would not be looking to initiate any long position here. I want a really good, healthy pullback. And the bottom line is this: this is going to be the next pullback and hold. If it makes a higher low from this previous low, then you might have a confirmation that that gold is done going down for a while. Remember, gold is in a bear market at the moment, and they do have some wild retracement rallies. But this is going to be the next lower high, or higher low, if you will, from this area. This is going to tell you that we have now confirmed that we might be in a short-term uptrend in gold. Okay, but I would not be buying anything there. Here's the OIH, and I was talking about the oil services, the Schlumberger, the Baker Hughes, the Halliburton. Love this sector. Still love this sector. But again, you're not going to chase it up here. I'm just showing you some of the ETFs, and this is what you do. You look at the OIH. Wow, it's up. Let's go into holdings, top 10 holdings. Take the top 2, 3, 4 best charts in that, and that's your ideas. That's how you find the golden nuggets. A lot of people don't tell you that, but that's how you look, and that's how you find it. Put a list of 30, 40 ETFs that you like to trade or you're interested in trading, and that's how you will find these nuggets. Here's Schlumberger. Beautiful base. Remember, and this is another way, when you see these base patterns like this is excellent. From this low, higher low, basing, right? And just really just creating energy, and look at the volume profiles. And when you get that breakout, you might not get it right away, and when you do get it, maybe it'll come back in again, but that's your cue to watch, to be ready. And this is a huge breakout here, guys. Now, another bull flag. I'm dying for market weakness. For another bull flag, there's plenty of opportunity. Here's the oil and gas exploration ETF, the XOP. One of my favorites in here is Valero, VLO. Again, beautiful. Came back in, tested the 20, popped up on Friday. I remember, guys, one thing I will tell you: when you have a liquidation in the equities in the S&P, everything good and bad will follow suit. Why? Margin calls. When margin calls get hit the market and hit a client, and they're down on their big time on their trade, they have to sell good quality stocks to pay for their margin that they would hold. Now, obviously, that's ludicrous. Just get rid of it. It doesn't make sense. I'm losing money. No sense holding into a losing trade, right? A lot of people still do that. Retail crowd does that. So they sell good quality stocks. They get under pressure along with the market. Everything gets liquidated. Remember that, guys. Except, of course, the defensive sectors. So that's why it'll come in. Be patient, and when it comes in, you scoop up all of the long trades. Here's my Valero. I love this. This is a perfect spot for the oil and gas. Let it come in a little bit. Again, this is a volatile stock, so you have to understand that. Remember, watch it for a couple days. If you're new and you like to trade it, give it a day or two. Find the characteristics of a chart. Every stock has its own characteristic. Remember that. That's Valero. Now let's take a look at the XLE. Again, love this sector as well, as Schlumberger is also involved in this sector. ExxonMobil is one of the biggest, so keep an eye on something like that. Again, look for pullbacks in good quality stocks. When the market sells off, you want to be paying attention to what's holding up. That is the stocks you want to go to when the market bottoms, or at least puts in a short-term bottom, okay? All right, so now here's USO. Again, with tensions out of Russia and Ukraine, all of their commodities will get bid up, right? Russia, good supply of oil, boom. Oil demand disruption. Grains, Russia is good with corn. They sell a lot of corn. So corn gets bid up. Give you an example. So watch this. This is important here. If you're looking to trade oil, well, now it's getting bid up again in oil, and crude oil's up again today, up $1.69 on this tension. So this is going to break out this USO. So we're going to probably hit the target of 38. Home construction. Look at this. Remember this? This is the home construction, and here we had home building sentiment was at its lowest, and they sold off. Remember, charts don't lie. We're in an uptrend. Look at this beautiful breakout, and look at some of the home building. Here's the ETF. Look at this. Absolutely awesome. And I said this in December. Banks, home builders, solars will be key top sectors to trade for 2014. I said that in December. It's in my morning call videos. Take a look at it if you want to rehash it. But this is excellent. And remember now, obviously it's extended. I wouldn't be looking to buy it. Look at Lennar, another one of my favorites. Fantastic here. Now it's getting a little parabolic. Let it come in again, right? Let it come in. And then look for a spot entry. Do a Fibonacci from this previous high to low, or this high to low, and then you could even go from here to this low, and see where a good spot for a pullback would be to dial into. Here's Pulte Homes, looking pretty good here. Again, another good one of my favorites, and KBH I love. Look at this base building from pretty much for the last 7 months. Love this base. Now we broke out. Let it come in and test the upper end of this support, which was resistance, and then that's where you want to buy that next higher low. Okay, and you just want to run through quickly the banks. Again, banks will be under pressure, obviously, and the banks right now are not the time to buy. Let it come up, let it base a little bit, and then on this next pullback, the bank should actually start to really start to move again. JP Morgan here, as you can see, and then Goldman here. Goldman looking really good. I like Goldman for a test of this 181 and 182 area. Goldman needs to get back above the 50-day moving average, though. Let it get back above it base a couple days, and then I think Goldman's a good trade. Once you break above this area here, you can see the volume profile is a big thin zone. So volume, at the very least, I'm looking for a test here. I do like Goldman. Actually, Goldman's one of my favorites as far as the banks. And then lastly is Apple. As you can see, Apple bull flag, we broke out. I think Apple breaks a little bit lower. Let's see if it breaks a little lower and it can put in a higher low from here. Let it base a little bit because Apple's a good base in stock, and then breaks out, as you can see. And then we look to buy for the long side. All right, guys, be careful here. We're actually sold off harder when we started this video. 1837 and a quarter, down 20.5 handles in the E-mini S&P. Okay? All right, be safe out there today. Let the markets come to you. Remember that. The trend is your friend. Cash is absolutely a position when in doubt. Okay? Have a great day. We'll speak to you tomorrow. Take care.